In this video, we are going to start talking about interest rate risk within the context of financial institutions. So, level and movements of interest rates. Let's talk about the Federal Reserve because that's where it all starts, the U.S. Central Bank. You have open market operations, which influence the money supply, inflation, and interest rates. Actions of the Fed, for example, in December 2008, in response to economic crisis, they needed to stimulate the economy. So they had a target rate between 0 and 0.25%. Then they eventually raised interest rates for the first time in 10 years in December 2015. What it means is that ever since around 2005, rates were steadily declining or staying the same. And with the financial crisis in 2008, they went even further down. And then around 2015 is when they started going back up. So they increased rates 6 more times by June of 2018. And that's the main interest rate that starts influencing every other interest rate in the economy. So the central bank and interest rates actions mostly target short-term rates. They meet every few weeks and they announce if they're going to change anything. Focus on federal funds rate in particular. Interest rate changes and volatility increasingly transmitted from country to country due to the increased globalization of financial markets. And by they mean increasingly transmitted, it's just happens. It's been happening for a couple of decades now, especially the larger economies. When they change their interest rates, they definitely have a more global impact. When the United Kingdom, United States, Japan, all the other ones that are big economies, when they change their interest rates, they do have a global impact because there's a lot of globalization, a lot of trading and business and foreign exchange happening, and it impacts everybody. Statements by Jerome Powell, the current chair of the Fed, can have dramatic effect on world interest rates. Now, this is what we're trying to say: statements, not even an official change, just an opinion, just any kind of, hey, we might do this, we might do that, we're looking at this, it's looking like that, maybe in the future. That would have an impact on decision making across the world, especially the United States being such a large economy that holds so much weight. Repricing model. So now we're going to talk about how the financial institutions, now we're getting more into the private sector, deal with these things, these interest rates, because just to a quick example to introduce this concept, they lend money out, right? So there's an interest rate that comes from the Fed, and then they have to add to that interest and in order to make some profit and mitigate risk by adding to the interest rate to actually lend money out. So they need to understand those changes over time. So let's start talking about things like that. Repricing or funding gap. Those are the two ways you may hear about it. The model is a simple model used by small financial institutions in the United States. Now, used by small ones because of the simplicity. Of course, the more complex your organization becomes, the larger it is, you may have to use more complex measurements. However, this is like a starting point. So it's simple, essentially, a book value accounting, cash flow analysis of the repricing gap, we'll get more to that in a minute, between the interest income earned on a financial institution assets and the interest expense paid on its liabilities over a particular period of time. Roughly speaking, a financial institution has liabilities. This is an oversimplified example. It's not quite yet the repricing gap, but so you can start getting the view of what it is. Let's say a bank has deposits from regular people, consumers, and on their savings account. And let's say that savings account is going to pay 1% interest, right? Then they're going to use that money to lend it out to other people and make money while that money is just sitting in the bank. So when they lend out, they're going to lend it out at an interest higher. So the loan becomes an asset. That's one way to look at it. And the liability is the 1% they're paying the person that deposited there. So that gap is important for them to keep track of, that interest income. Here at the bottom, it says contrasts with market value based maturity and duration models in the appendix. You can see in the appendix in the book. We'll talk about that later. But the key term there is, notice that in the bullet, it says book value, not market value. And that can bring some issues. There's some weaknesses to the model. But like we said, it's a starting point. Some vocabulary terms related to the repricing model. Rate sensitivity. It means repricing at or near current market interest rates within a specified time horizon. What they're saying is that gap that I kind of explained earlier, the smaller that gap is, the more sensitive that rate is going to be to changes. Because if the market changes and you had a small gap, you may have problems. Repricing gap is the difference between rate-sensitive assets and rate-sensitive liabilities. Similar, like we explained a moment ago, you have the liabilities, that's the rates you got to pay out, and the assets are the ones you receive rates as revenue, to put it that way. So the gap is the difference between them too. Refinancing risk and reinvestment risk come in play, and it has to do with the time. We'll talk about the time buckets in a moment, but as you are paying out interest rates to your depositors or your liabilities, and you're trying to collect from the loans you make, you will need to do some kind of matching. You don't want to have short-term interest rates to pay out and lock in a long-term interest rate that you receive, because then the short-term one is going to change, but the long-term one that you're receiving, if it's fixed, is not going to change. So you may have some issues there. And this is where this refinancing and reinvestment risk come in play. That's just one example out of many, many situations, scenarios. So one way to start dealing with that, you want to create what we call the maturity buckets. Commercial banks report quarterly repricing gaps for assets and liabilities with maturities of 1 day. Yes, there are some things that expire within 1 day, overnight loans, etc. More than 1 day to 3 months. Those will be like the super short term. You get the 3 to 6 months, still short term, but obviously not as short. More than 6 months to 12 months, more than 1 year to 5 years, more than 5 years. What I was trying to say earlier in the example is, if you have stuff that, like a mortgage, that's 30 years and it's a fixed rate, and that's an asset, you put out a mortgage loan, and it says a fixed rate of 5%, then you got to deal with your liabilities that are also long-term. Because if you are backing up that mortgage loan with short-term ones, like 3 to 6 months, if these interest rates start going up on your liability side, and that's what you're using for those long-term ones, you're going to have problems, because that one is not going to change. It's fixed. So these rate-sensitive assets, these are just some examples that will be in a balance sheet. Short-term consumer loans reprice at year-end would just make 1 year cutoff. So short-term within 1 year. But now you got the 3-month bills, reprice a maturity every 3 months. You got the 6 months, they're repriced every 6 months, and the 30-year. Now, the 30-year floating rate is not the same as the fixed rate that I was talking about. So here the rate gets reset every 9 months, because even though there's 30 years, it's a floating rate. If it was a fixed rate, then no, it'd be a different situation. those were examples of rate sensitive assets. Now we're talking about rate sensitive liabilities. So here your depositors, they might buy CDs from you. They might buy commercial paper from you. They might do high yield savings accounts, but within a short period of time, all these things. So these are like the depositors that I was talking about. So they got to pay these out. And these ideally would have lower interest rates that they pay out compared to what they receive for these. And of course, as we mentioned, 3 months, 6 months, they're gonna have different time buckets. Now they come in different ways. These are just examples. Now, demand deposits. Let's think of checking account, for example. There is a debate whether if somebody has money in a checking account, should that be considered a rate sensitive liability? And because the checking account is not paying interest, it's just sitting there. However, it's not collecting a fee either. They charge it, some banks do, but let's say it's a checking account that they're not charging any fees to the consumer, but at the same time, they're not earning anything from the consumer. So they're not charging any fee from the consumer, so they're not earning anything from the consumer. But there is cost associated with the bank managing and administering those accounts. So there is that argument that, well, even though it's not an explicit interest that you're paying, you still comes at a cost, and you can put a percentage to that, a rate. So here are just the arguments saying like, yeah, we should include it. These are the people saying, yeah, it should be included. Explicit interest rate on demand deposit is 0 by regulation. That's what I was talking about. They don't actually charging anything or paying out anything, but they do have costs that are associated with it. So it's saying that they don't include it because there is no interest rate. Rates paid by financial institutions do not fluctuate directly with changes in the general level of interest rates. So they're saying it's not associated, it's not linked, and act as core deposits. That's what it's saying, like, yeah, don't count it. Now, the people say you should count it is the other part that I was talking about, that even though they don't pay any interest rate, they are costs associated for providing those checking services, and they're not charging for it. So there is, they could put a type of rate of cost to it, but still open, not part of the formula. It's still a debate. Weaknesses of repricing model: ignores market value, effects on interest rate changes. Okay, so there are the book value ones, and the ones that the Fed puts a number, then you add the premiums, and you end up with a certain percentage, and that's all book stuff. However, if you recall, for example, when you are learning about bonds, aside of the coupon rate and all that stuff, there's a yield to maturity, which kind of includes the market sentiment. There are other supply and demand issues, liquidity things that change the actual market value of a bond versus its face value. That'll be just one example that they ignore here, those influences that happen in the market. So you might be taking risk that is not showing within the book values. Over aggregation, distribution of assets and liabilities within individual buckets is not considered. The repricing model pretty much looks at everything as a whole, even though we do have the ability to put in the time buckets for risk to manage that risk. But when they look at it as a whole, there is not being considered in that model. Mismatches within buckets can be substantial. Going back to the time buckets we were just talking about. And another thing too, when they say mismatches, let's go back here, the rate sensitive liabilities. These are just some examples of different other timelines and all that versus assets. They don't always match 3 months, 6 months, like right on the spot, or even if they have 2 6 months one, the actual expiration date or maturity date could be different. So mismatching does happen no matter how hard you try to get organized. And weaknesses of repricing model, ignores effects of rate insensitive runoffs, bank continuously originates and retires consumers and mortgage loans. The retires by continuously, I'm gonna give 2 examples where they can be considered as a retiring in a way. People that may pay off their loan early, or they just go ahead and package those loans and select on the bank. That happens all the time. Then you got the off-balance sheet items that are included when considering cash flows. So as we mentioned earlier, the way you do the repricing model is with the numbers on the balance sheet. But there's a lot of other financial transactions that happen within a financial institution that are not on the actual balance sheet. Here are just a couple examples that you should be familiar with or heard before. You have hedging. It's an off-balance sheet item that is not captured there. And future contracts are an example. So yeah, options also used and forward contracts also used for hedging. There are a lot of other financial tools and transactions and instruments that may not be shown on the balance sheet, but have an impact on this, would have an impact on what's really going on versus what the repricing model captures. But just so we don't forget, that's why on this slide, it mentions that it's a simple model used by small financial institutions, but it's a starting point of the discussion on how these work. That's it for this video. See you on the next one.